And I think it's let's go with Fed.
Don't sit right there.
Going out tonight? Hi.
How you doing?
What's wrong, vacation? Oh, do you want to put down the time, or you want to just take off time for another day?
Kurt's already filled out.
It's a little late.
Jerry, whenever you're ready.
Now, I know it's not a big word.
All right, let's call this new agenda meeting to order. Please, out of respect, please silence all cell phones and remove all hats. Let's have a moment of silence and let's pledge allegiance. I pledge allegiance
To the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you. Carol's going to introduce our special guest today.
Good afternoon, everyone. Thank you for coming. I'd like to introduce John Lejean from Lejean and Lejean Company. He was the auditor that did our 2020 financial audit. Mr. Lejean will be reviewing the audit. We'll briefly take questions once he has completed the review.
We're going to limit the questions to 3 questions per resident, and Susan will pick to the whoever's going to stand up and speak.
Okay.
Okay, if you want to go over with us real quick, like what you found out, and give us a report, please.
Hello? I want to thank everyone for showing up. Can you all hear me well? Yeah, my name is Percy Lejean with Bezier and Lejean CPAs. We're out of Tampa, Florida. I've been doing HOA condo work, co-op work for over 35 years. So I'm just going to kind of go through the highlights of your balance sheet and income statement, then we can go ahead and take some questions, and hopefully we can get everybody's questions answered. If I don't have the answer today, I'll get back to whomever it is. So this is as of December 31st, 2020. A lot of people, when they look at a financial statement, they look at two different things. They look at cash or they look at equity or fund balance. People see cash, they see $1 million. Oh, we have $1 million, it's great. That really doesn't mean anything if you have $1 million. Obviously, if you have negative $1 million, that means a lot more than that. But you have to look at the financials as a whole. And what I'm gonna do at the end is kind of give you a little ratio thing that we use to see if an association's in good financial position or not. At the end, I'm gonna talk about reserves, because that's very important in today's environment. Costs are going through the roof. With the disaster in South Florida, it's kind of changing the landscape of the whole industry. A lot of task force going on, a lot of different opinions on how we should go forward on treating reserves, should be able to waive them, etc. So a lot going on in the industry. Tampa Bay area where we are in all this, really the past 20, 30, 40 years haven't really been affected by a direct hit of a hurricane. But when those hurricanes hit Fort Myers, hit Louisiana, etc., that has a bearing on us. There's no roofers around here because they're all in different parts of the country. Materials go up, labor gets up, and right now, insurance, we see 200-300% increases in insurance. A lot of that's on the condominiums that are on the water, etc. A lot of carriers that even exited Florida, so now we're back to only like 2 or 3 different carriers. That whole market is making most budgets go up about 30%. Between the insurance and an updated reserve study, we see most people's budgets going up 30%. So that's kind of overview of where we are. So I'm gonna kind of go through your numbers. I'm gonna start with the operating fund. The operating fund is the money we collect for the day-to-day operations to run the association. Whereas the reserve or the replacement fund is where we collect money over the years to do major repairing projects. The accounting for the reserve section changed in 2019, which is a major change in GAAP, and I'll kind of go over how we calculate income and expenses for reserves based on the new GAAP. So, I don't know my mask on, I hopefully won't fog up. Our operating cash at the end of the year, we had $327,000. Assessments receivable, we had about $59,000. That's people who, October, November, December, like the end of last year, that we still owe those payments. That's our net receivable, which 58 sounds like a big number, but for how big the community is, it's very reasonable. In 2008, when the housing market just crashed, a lot of associations had 30% of the people not paying, especially the brand new subdivisions that came out of the ground. So you're relatively in good position there. We in the industry did not see a big tick in bad debt. Now, one, we thought when COVID hit and a lot of people lost their jobs, restaurants closed, that we would see a hit on that. But with the deferral, when you don't have to pay your fees sometimes, mortgages, etc., I don't know if that came into play, but overall in the industry, we really haven't seen an uptick in bad debt. So hopefully we've made it through COVID, or going to make it through COVID, and won't see that uptick in bad debt. Unfortunately, if we do see that, the people who are paying are going to have to pay for the ones who don't pay. I can tell you the people who actually go and foreclose on people who don't pay come out way ahead. Lots of times it's a hard thing to do. They're your neighbors, etc. So you should have a good policy in place. Hey, they're delinquent. We send them a letter. We send it to the attorney and go through the legal route as opposed to, well, you let so-and-so pay late, you did this and that. And we see some boards get in trouble by doing that. So like I said, at December 31st, 2020, we had approximately $327,000 in cash. We had about $59,000 in accounts receivable. We had prepaid expenses of about $31,000. That's usually for most associations, prepaid insurance. While we pay our dues maybe once every month, once, 1/12, and you have different options here, but the insurance guy wants his all up front, or we can finance our insurance. So we have a net property and equipment of about $600,000. That's all the fixed assets, the lands, the building, et cetera. So a lot of HOAs and condominiums, sometimes they report to fixed assets, sometimes they don't, depending on the criteria. So your equity is $861,000, that's our fund balance. But of that amount, $635,000 is the value of the assets depreciated. So that is not saying we can go sell it for $638, that's just a cost less depreciation. For GAAP accounting, you're required to be conservative. They tried to do fair value accounting, and when you do fair value accounting, that's when people start, my partnership is worth X, and they keep raising the prices. Oh, our land and building here is worth $30 million, and they go out and get loans on it. So GAAP says cost less accumulated depreciation. So at the end of the year, we also had an accounts payable of about $42,000. That's generally bills we incurred like in November, December. So let's say December 20th, someone came and cut a bunch of trees for $10,000, but didn't give us the bill till January. We didn't pay it till January. Those services were incurred the prior year, so we have to put a payable for those. So you have to match your income and expenses. Then we have prepaid assessments of about $118,000. So that's people who paid their January 2021 maintenance fee in November or December. So when I look at it, I see we have cash of $327, and I go, what if we backed out all of our payables and paid them on the last day of the year? That'd be less $40,000 in cash. And what if we didn't collect any money in advance? We only reported the money we collected for 2020. So we back out that 118. So I call our excess operating cash number about $167,000. That's what we have. So even though we have $328 in cash, if we back out the liabilities that incurred with that, we have $167,000. And the way we look at that number is we compare it to your expenses. Your annual expenses are about $1.2 million after you back out some of the other income items you have. So your operating expenses are about $100,000. 1.5 months, $150. So we got about 1.5 months worth of operating expenses. We recommend anywhere from 1.5 to 3 months worth of operating expenses. So that's kind of how your balance sheet looks on the operating side. Your assessments for the year were about $1.1 million. We collected over $200,000 in other fees and late fees, et cetera, helps offset what your dues are. So our total revenue was about $1.33 million. It's not a little, if it's a large association that we're running, it's just a lot of money, a lot to be responsible for. I'm gonna go through the major expenses, then I'm gonna break down some of the categories. But obviously payroll, salary is a huge item here. So administrative expenses for the year were about $450,000. And I'm gonna go through a breakout of the bigger items a little later. Depreciation was about $60,000. That's when we buy fixed assets. We have to depreciate them out over a certain number of years, depending on what type of assets they are. That's a non-cash item, so we don't really need to collect depreciation when we're collecting our fees. Court enforcement expenses for that unit was about $357,000. Facilities was about $273,000. Public works was $232,000. So our total expenses were a little shy of $1.5 million, which is kind of on the high side generally from the previous years it looked like. So we had a loss of $158,000 last year. Some of the major expenses in our categories. For administrative, some of the major categories were attorney fees, $46,000, computer expense, $22,000, CT credit screening, $22,000, insurance, 50,000, payroll salaries is 164, payroll taxes about 31,000. That was an administrative category. Court enforcement, salaries, $289,000. That was pretty much the biggest expense there. We had some health insurance, payroll taxes. Facilities, the salaries are 165. Equipment and expenses about $28,000. Building maintenance and repair, 21,000. Electricity, 28,000. And on the public works side, salaries, 99,000. Electricity, streetlights, 85,000. Equipment and expense, repairs and maintenance, 14,000. You know, those are your main items there. I did take a look at the 2021 budget. We had a little increase, I think, from $45 to $48. I strongly recommend, not I'm going to go over the replacement side, and I think you're in the process of doing it, or have it scheduled for next year, is get an updated reserve study. I am an avid fan, and you're going to hear a lot of talks going forward about it. Get the reserve study and just pay the guy to update it annually. Too many people are getting in a trap by using the same number for 3 years, 4 years, 5 years. And over a 5-year period, especially, prices are up 30% in 1 year. So someone got a reserve study last year, it's 30% too low today. Sometimes that's just a spike because we had a hurricane or we had something that caused it to go up. Obviously, we all heard lumber going from $35 to $75 down to $50. So those spikes, you gotta look and take into account for those. But you can't just say, hey, we're gonna do a reserve study, we're gonna take 3% inflation. Because the products we use, gas, oil, roofing, tar, materials, roads and streets, those are not going up 3.5%. So you gotta look at the components we do have. So I'm an advocate of getting that reserve study done. We do not have an opinion on the reserve study. We do not have an opinion on whether it's enough or not. That's not part of our duties, but we do disclose a lot of stuff that's required by GAAP to do that. So I'm gonna kind of briefly go over some of the reserve stuff we have items and the new accounting method for it. So roughly we have, at the end of the year, approximately $1.8 million towards major repairs and replacements. And from the last reserve analysis that was done, and it's been updated, throughout the years a little bit, but I like the independent outside party doing it. That's just my opinion from being in the industry. The total estimated replacement cost of everything is about $17 million. So they have $17 million for all the structure, the elements, etc., and we have $1.8 million. That 1.8 could be enough, not enough, but I'm just looking at it as a percentage. It seems low, but the way you do it is one, either a component method. So the roof here is going to last 20 years. It's going to cost $200,000. You take $200,000 divided by 20, and that's what we need each year. You do that for all your components, or you do a pooled method where we do a cash flow. Basically, you use Excel and you list all your expenditures out. And you got to put in each year enough so that your balance never goes below zero. And I'm an advocate of the pooling method myself, more than the component method. They both got pros and cons. I can argue each side, but I'm just kind of telling you how, basically what we see. Now for GAAP, I think your number is $400-something thousand that we collect for approximately $450. Before they changed the accounting rules, the $450 was reported as income. So we'd have $450 in income year one, $450 in income year two, year three, $450. Now we spend it all. So the last year we had $450 in income and $2.2 million in expenses. So it kind of skewed the financial statements. And the way you account for a special assessment, I'm going to kind of go through that a little bit, and that kind of correlates how they changed the mentality on how we account for the reserves now. So let's say we did a special assessment of $100,000 to paint 4 buildings at $25,000 apiece. We did the assessment November 1st, we collected all the money by the end of the year. So the end of the year, we would have $100,000 in income, in cash, we collected all the money, and we'd have income, $100,000 for the reserve method. But for a special assessment, because we didn't incur any cost on that, it would be called deferred revenue. So we'd have cash, 100, and a liability, we owe this $100,000, i.e. to a painter. So in January, the guy paints the first building, and he gives us a bill for $25,000. So we would book the payable for $25,000, then we would relieve the deferred asset, the liability, to have income. So you'd have 25 in income, 25 expense, and every time you incur another cost, you do that, match it. So now that's what they do with reserves. So an association like yours, your equity was 1.8, now you have a liability of 1.8. A lot of banks, we have to educate the process on that. So now, going forward, you see your income and expenses kind of matching each other. So that's kind of basically where you are overall. Like I said, we got about 1.5% of operating expenses. I would like to see maybe in the future to kind of beef that up to maybe 2, 2.5, or 3. Because now we are seeing the unanticipated expenses come through. It's different for you than a condominium, because condominium, that insurance number is huge. And when it doubles, triples, and you cannot get it, it really skews the numbers a lot. And I've been doing this long enough, when you get your updated reserve study, those numbers are gonna bounce pretty good, so you wanna be on the lookout for that. I think you're having scheduled to do next year to incorporate into your 2022 budget. I would give the reserve guys, say, hey, what if they updated every year, what would it cost? And I think I would try to incorporate that going forward. I think that'd be one of the best things you can do, as a whole for the associations. And I'll open it up to any questions if anyone has. Yes, sir. Is that okay?
Larry Miller, you too. A minute ago, you said last year we had a loss of $158,000. I'm looking at the front page of this audit, and it said, according to QuickBooks, we were $175,000 in the hole in 2020. But after the corrections, adjustments, we had a profit of $117,000. So is it $117,000 plus, or is it $158,000 negative?
I'm not sure what you're looking at as far as QuickBooks. I'm not sure if they made a records to last year. So I would have to look at that to be able to answer that question.
This is what we were given for the audit report. It said right on the first page. So can you tell us, regardless of this
I'm
report,
not sure what you're looking at.
how much money do we have left in 2020?
In the operating fund, we had a loss of $158,000. Now, that does not mean we lost $158,000 in cash, because we got some depreciation method. It's on an accrual basis, which is required by GAAP. So generally, when they post my entries to your records as of December 31st, 2020, we should agree. So maybe I have to get with the office to see that.
You're taking a figure and then said, well, we're gonna take depreciation. What I'm really interested in, how much cash in hand did we have at the end of the year to start 2021 out with? Okay? Don't care about depreciation.
At the beginning of January 2020, 1/1/2020, we had approximately $482,000 in cash. At the end of the year, December 31st, 2020, i.e. 1/1/2021, approximately $327,000. And that's in the operating fund. In the reserve fund, we have cash and investments, so I don't have that exactly ready to tell you. That's the operating.
We got two different categories. I'd like to stick in the operation.
Yes, sir.
And I believe you just said, at the end of that year, we had $321,000 left over to start next year. That doesn't seem feasible.
What do you mean by feasible?
Well, it just seems unreasonable that we could have $321,000 left over. Where do you get that?
It's not left over, that's your balance.
Okay,
You started off with 482, and now you're down to 327. The association had 327,000.
association on December 31st had $327,000 of cash to pay future bills.
Yes, sir, and a lot of that was prepaid, where people paid their dues in December before January.
We gotta pull that out, because that would go to the next year, right?
That's what I said, that's what I was trying to explain earlier. Let me go through it. We have cash of 327, and I said, let's just back out our accounts payable. Saying if we paid it all at the end of the year, that'd be minus 42,000. And our prepaid expense that we got earlier was 118. So I call this excess operating cash 167. But your true cash balance is 327. Did that answer the question better?
If I was a bookkeeper, I'm sure I'd understand that, but I'm not. So, I guess if that's true, we had a ton of money to start the year off with, 300 and some thousand, or 200 to take the other stuff off.
I'd have to go back and look at the balance sheet, yes. Like I said, you're about 1.5 worth of your monthly expenses, which you're realistic, I'd like to bump that up. Yes, ma'am? Over here.
You got it? Okay.
Yeah, Metcalf Unit 6. I think what Mr. Miller and many other people are asking is, were we in the red to start January 1st, 2021 for our expenses for this year? Larry, is that,
But they're saying it's about 160,000 in the black.
Correct, we were not in the red to start the year.
so we were not in the red,
Cash-wise, no.
cash-wise? Okay. If we take into account the whole budget as of January 1st, 2021, would we be in the red or in the black?
Can you repeat that question, 'cause I'm not sure what you're asking me.
You said cash only. Is that what you said, the
167, if we back out the accounts payable like we paid it and the prepaids that we collected.
Okay, so we had $157,000, $157,000 in the black for everything for January 1st, 2021.
Yes, ma'am.
Okay.
And you do need, like a lot of people say, well, why don't you give this money back to all the people? You need money to operate something. You need to be able to have cash flow to pay bills, et cetera. So like I'm saying, 1.5 to 3 months. I'm saying 1.5 is, okay, you want to be close to that 3 number. Yes, ma'am.
Val Stratton, Unit 3. I see a slight difference from last year to this year as far as the members' activities or the activities fund. I noticed that that's included in the operating. And what is in member activities? Is that donated funds in the clubs or is that operating revenue?
There's a lot that goes into that. Let me check real quick. Also, because of COVID, I think a lot of stuff was like down. Like in general, for most associations, golf was down, meetings were down, stuff like that. But let me just kind of go through something in 1 second. So just in general, on the operating other income, mowing charges, PW tree trim fees, VRC fines, enforcement actions, that's nothing. late fees, attorney fees, foreclosure fees, estoppel fees, copy of postage. We sold a couple of units, we had a gain on loss, some of the units, stuff like that. Those were the items there.
Because on the audit it says, member activities income of 21,196, but member activities expenses 41,177. And I was under the impression that was clubs and donated funds.
Give me 1 second. I don't have the detail on it with me here, but I can get back to the board on that.
Appreciate that.
Very good question. ma'am.
Because I'm thinking that if it's, member activities like donated funds and clubs, it wouldn't necessarily be an operating expense. Because those are activities outside the purview of BCPO management.
Okay, I understand what you're saying, yeah, because we do have separate line item for the donated items that come basically in and out, approximately 25,000, 20 million.
Mary Story, Unit 6, looking at your replacement fund of $273,084, we actually made 9 deposits of $43,890, which comes to $395,010. Why is there such a difference showing there?
Yes, that's what I was trying to explain earlier with the change in gap. Previous to 2019, the money you collected would go as income. Now the money you collect goes as a liability. And as you spend it, you record the income and expense together. So I'm gonna go back to the painting of the building. We passed a special assessment for $100,000 in November. We collect all the money, so at the end of the year, we're gonna have cash $100,000. Now, if we do it the old way, it'd be income $100,000. Then, so we can equal, hey, it makes sense, we collected 100, we put it in there. Now, it doesn't work that way, you put it as a liability, and when we spend the money, then you match the income and expense. So in January, we paid one building for $25,000, we have an expense, and then we have an income that matches it. So previous to 2019, what you're saying, that's how you record it. Now you match it with your expenses. That was a major change in gap in 2019. So you did collect the money, it's stuck on the balance sheet as a liability, a contract liability to be spent in the future.
But these monies were actually deposited into our reserve account in that amount. And I understand you're taking expenses off of it of the 292, but your actual revenues that were put in the bank were 395,000 and change.
Correct, and it's included in the balance sheet in the 1,766,000.
But you're not showing it on the page 4 where it says regular assessments?
That's not gap. Nope. But you did collect the money, it's in the bank, it's in the liability section to be spent in the future. Yeah, that was a major change, a lot of deliberations back and forth, but, that's how you properly account for it.
Linda Walls, Unit 4, the audit you did, is that a tax audit or a statutory or a financial?
Financial, yes, ma'am. That's a good question.
Yeah. This is Gail Metcalf, Unit 6. This is tagging on other questions. Percy, there was 9 payments made to the reserve fund last year. There was supposed to be 10. When the new board came in, March, whatever, they had to make the payment for last year's. And that was about $44,000 or something like that. So you said that we were ahead We had excess of $158,000. With that $42,000 or $44,000 that had to be paid, that should have been taken out of the excess. Is that correct? Because that was a bill that should have been paid in 2020.
We're talking about two different issues. We're talking about the operating cash and the reserve cash. So they don't correlate. I'd have to go back, I know what you're saying, I'd have to go back and check, but the number we're starting with is the operating fund. Now, we had let me look.
Also, while you're looking along the same lines, we have bills and they, there are bills that happen at the end of the year, last couple of months, because they don't come in until the end of December and into January. Would those bills be carried over with the $158,000 excess also?
No, we backed those out, because we had the accounts payable of 41,000. So I backed it out of the 327.
Okay,
Thank you.
thank you.
Well, somebody has written an announcement.
Okay.
Mommy has three questions.
Any other questions?
Ellie Cows on T, Unit 4. On the reserve, you said for repairs, it would be $17 million if we had to do that. Do we have insurance on these buildings?
And yes, you have insurance on it, yeah. But you still need to maintain and repair the buildings as you go along, provided, go ahead.
I understand that. I'm just saying 17 million, is that with no insurance or plus insurance? If we had to replace everything?
No. Two different issues, and maybe I spoke out of context or whatever. What I'm looking at is what a reserve person said, the total dollar amount to repair and replace the various components, which they have a detailed list of it. That has nothing to do with the value that an insurance company puts on something to say what it is. So it's just two different things.
Also, I just wanted to say, bingo hasn't been played in a year and a half, and that was $27,000 that we gave to the community that they're missing, so. Thank
No,
you.
it's happened at a lot of places. You understand about that 17 million?
Tracy Nicumber, Unit 2. This is for any HOA in particular, and I thought if you're versed, maybe you could answer this. If a budget is not passed, can you hear me? If a budget is not passed, could that be concern for a special assessment in the future?
Can you repeat it? I just couldn't hear you a little loud.
Sorry.
I think I understand. Go ahead.
If, for any HOA, not just ours or any, if our budget for the year is not passed, could that be a concern for a special assessment in the future?
I'm gonna repeat the question just to make sure I heard you. If a budget is not passed, could that lead or could that be grounds for a future special assessment?
That's correct.
Okay. I'm speaking as an accountant, not an attorney, because I don't have a law degree. I think the law is I like my guys to pass a budget, all my associations. Sometimes if they don't, I think the law says you revert back to the previous budget. Now, if you have enough money and all that, and enough funds, that doesn't necessarily mean you're gonna have a special assessment. I got clients that pass a budget every year, and they special assess every year. So there's no correlation between the two. It's just a matter if you're properly running your budget, looking at your expenses, and making the necessary adjustments. I got some people who kept the fees the same for 10, 15 years. All of a sudden, boom, it's got to go up 50% because they didn't do it properly along the way. So two different issues. I think at any time, an association, they gotta get your documents. Sometimes the board can do it, sometimes it needs member approval. Can borrow money, have a special assessment, et cetera.
Thank you.
On page 4, you're showing taxes I assume that's the federal income taxes of $2,602. That was for the interest that we earned.
Yes, you pay tax on your interest, less than expenses, et cetera, yeah.
I've got a question here. I got a question. When you look at the budget, does this is a rolling over, right? It rolls over every year. I mean, as far as that shortage going to be like, is it going to be compounded on this or just last year?
Okay, good question. I tell all my clients, and everybody, you sit down and you go, Percy, we collect $1 million, we spend $1 million, it's, there's nothing left here, there, whatever. The very first step you should do when doing your budget is, how much retained revenue do we have? Do we have that 1.5 to 3 months worth of operating expenses? So we could lose another 150 this year, probably wouldn't matter. We could probably lose another 150 next year, wouldn't matter. But somewhere down the line, it's gonna matter. So right now, with that 1.5 that you have already, and I'll look at your budget for next year too. As long as you just each and every year look at it, you're fine. I got some associations that have 1 year's worth of fees in the bank. I'm going, all right, guys, that's getting kind of gross. You know what I mean? That means we can not charge people fees for a whole year and still have money. So you don't want to have this big, huge surplus. You don't want to be running in the hole. So like I said, each year if we just look at it and say, hey, 1.5 to 3 months is what we want, it's going to fluctuate up and down. No ifs, ands, or buts.
So another question I have is, so when you did the accounting, say the accounting changed in 2019, that means any money we spent this year, like, say, fixing the tennis courts, fixing the roof, which is gonna start next week, that's gonna turn into a negative, right?
No, because we have the contract liability. We have $1.7 million.
Okay.
So when we fix those, we're gonna take that liability number and put it as income and match it. So as long as you get an updated reserve study, I'm saying that updated every year, I think when you get your new one in, the numbers are gonna, I just know because that's what they've been showing. We might have to change that contribution going forward. And I'd say updated every year, that way there's no surprises 3 years, 5 years down the road.
Okay, I got one more question is, okay, it went from, according to a year-end sheet we had, it was, $88,000 over when you look at the profit and loss. And then it went to 160 the other way. So that's a combination of what? Bad debt,
Bad debt was,
depreciation,
yeah, those,
and
yeah.
what else would cause it to be?
Those are the two biggest ones, probably. I think it was 60,000 depreciation and like 78 in bad debt. That was most of it had to go through. We might have some change in the gain or the loss of the sale of a few units.
So, okay, well, go ahead, I'm not gonna ask this question yet.
Val Stratton, Unit 3. Speaking of bad debt, are these actual accounts that get closed once we write them off? So we would no longer be able to collect them? And if that's the case, did the board give an accounting to you of which ones they felt were uncollectible?
Generally, how it works is we have CPAs, we have to use conservatism. So under the current statute, generally you can collect 1 year's worth of fees or a percentage of the original mortgage. So generally, we do our analysis, we look at it, and we leave 1 month, 1 year of fees as collectible. We do not write anything off. It's just an allowance. So here's our AR, we're saying of this amount, X we think we're not gonna collect. Now, when you do short sales, you collect it all. Foreclosures, you get the 1 year. Some banks pay more than they have to. Some banks come back and sue you 3 years later because they paid you too much. Generally, once they go to the attorney and the attorney gets it settled, that's when most of the accounts are cleared up. That doesn't mean you cannot go back and collect on someone later. To be honest with you, we got some associates that keep prior bad debt on there, and it just mumbles you up. You can't get bought out of return. You're better off cleaning up your financial statements and going forward, in my opinion.
Will this, then reduce our accounts receivable figure? Or will it stay the same when we take bad debt?
Well, you talking about when you collect it?
When we write it off?
Oh, you write it off, it doesn't change your AR number, because it just goes from AR to reduce the allowance.
Thank you.
You're welcome.
Ted Landon, Unit 4. I've got just one question. I don't know if you can answer this or not, but I think it would be good for all of us. Do you feel that the $3 increase in the assessment is unreasonable?
Do I think the $3 increase is unreasonable? Yeah, I think it is. I think you're gonna find out it should be $20 by the time you get your new reserve study. And, you know, it's funny, but it's not funny. I really want to be prepared when that reserve study comes back. Because I've been doing this a long time, and it's happened twice in the 35 years where, like I said, most people are going up 30%. And that's a high-rise condominium, different, insurance is factoring in, but, yeah, that reserve study is going to change it. I hope not, but I just know from my experience. Very good question, very out in the open. I have no problem with that whatsoever. I know the board's trying to total out on this and that, but I get more boards getting people in trouble in the long term by keeping the fees low. And I literally had the one guy, he was 95 years old, he was the president. We put a brand new roof 2 years ago. I'm not gonna be here 20 years from now, we need a new roof. And I said, I appreciate that, but as the board president, your responsibility is to look out what's best for the association. Maybe you might not be here in 20 years, but hopefully your association's in there in 20 years, and hopefully you have the money to redo that roof in 20 years. Another thing while we're talking, and obviously we got different type of community here with the mobile homes a lot, but a lot of underwriters, you got a house, they got a roof, 15 years old, it could be solid golden for the next 20 years, they're making you get a new roof. So we see a lot of insurance companies, I don't care if it's been there 10 years, you put in, if it's in 6 years of having to be redone and making you redo it, mind-boggling to me. But that's what they're doing. They changed the flood map in some of the areas. Someone who had no flood insurance, they called me the other day, $4,800 a year. Look, the same house been there for 20 years, zero. They changed the plane, $4,800. And I think that flood thing is based on the government, so it's not like you can go either shop that either. I don't think you can. Thank you.
So basically from that analogy, we probably should be at about 60, at least $60.
Well, it just depends on when the reserve study comes in at. You know what I mean? So I think it's important to get someone working on that. You can't ask them in June or July or August to get something for your November budget. It's not gonna happen. So they need to work on it now to be prepared so we can look at those numbers for the 2023 budget.
Well, let me ask you a question independent of this. How is you're doing accounting for like other HOAs, how's the minimum wage affecting the increase in most places?
Repeat that again, please.
How much is the minimum wage increase affecting most associations?
How is the minimum wage increase?
Yeah,
affected?
I mean, yeah, other than raising it, but how are they dealing with it?
Most associations are using management companies because their high-rise condominiums are 300 unit, single-family homes. So we haven't seen it hit too much with the management companies. 3 million unit make a ton of money, so they're eating a little bit of it now, but eating some of that cost themselves. Where we see it now is getting with the landscapers, because the gas prices are going up and this and that. Normally you gotta pay for $2,000 a month, we'll come cut, whatever number of years, and now it's like, my price just doubled, and they're trying to get increased fees, and some people are saying yes, some people are saying no, and I've seen them just break contracts and quit cutting people's grass. So, you're gonna see that hit somewhere down the line. We haven't really seen it hit too much yet, from what I see.
Okay. All right, thank you.
It's no different than the person, working at a fast food place that's making $15 an hour, or the person that's the hostess making $15 an hour. Where the cook's gonna go, why should I cook hot, sweaty in the kitchen for $16 when I can be a hostess for 15? So I think we're gonna see things change, and me, I look at it and go, how can you do $15 for California, New York, and Podunk town in the middle, still $15 is great, but it's not really, you gotta look at the industry and where you are and where you're located. 15 probably too low for New York and California, anywhere in there, and 15 might be too high for some small town. But that's where we are today.
Okay.
Hi, Vicky DeDario,
You guys are pretty closer, I think.
Vicky DeDario, Unit 4. My question is, if they feel it's necessary to raise the HOA fee and it doesn't pass, will we have to take cuts somewhere else to make up for that?
Okay, I'm gonna try to repeat your,
What's gonna happen if the budget does not pass?
she's asking if the budget doesn't pass, what happens, do we have to cut fees here and there ever? I'm not sure on your specific documents or whatever, because some documents, the board can pass the budget, some of them needs the HOA members to approve it, or a special stuff, or a loan. That's more of a legal question. So on yours, does the board pass the budget, or does the?
Membership passes the budget, so we're dealing with that right now. People are voting for it, yes or no, so.
Okay, so yours requires the membership to, all right. I've seen that happen a few times. I'm not gonna say right or wrong, I'm just gonna tell you what I've kind of seen. Some, the board can get a loan, or the board can special assess. Obviously, if you're approving the budget, generally the special assessment would have to be approved by the membership also. I've had some legal firms I've seen say, we don't care what your documents say. We don't care what Florida statute says. I'm protecting the association. I'm protecting the board of directors. I'm gonna put in writing to you raise their fees to whatever they need to be to properly run that association. Because me as an attorney, I don't need my board getting sued because the insurance didn't get paid, no one fixed the light outside, and someone got shot by it, et cetera, et cetera. So I don't have an answer. I would go to the attorney for that. I can tell you a quick story. A lot of HOA documents do not allow the fee to go over 10% without membership approval. And this goes back like 15 years. It was a single family HOA. They paid annual dues one time a year in January. And when they calculated their 10% increase, it came out to be the maximum they could charge was $359.60. $359 was the maximum. Guess what they made the coupons out for? Somebody guess? Nope. $360, we're gonna round it up. I ain't gonna lie, that makes sense to me as a CPA. $25,000 in legal fees later, they have to refund everybody 40 cents. I am not lying, I saw the deal go down. That's why it's important to dot your i's, cross your t's, consult with the legal people when you need to. That was ridiculous, that was a waste of money, and the attorneys are the only ones who made out.
Linda Hartman, Unit 1. I'm hearing rumblings that we're around $160,000 in the red. And you're saying that we're in the black. Can you squash these rumors that we're hearing?
Okay, some of the rumors right, some of the rumors wrong, so we gotta make sure what we're looking at. For the year, accrual basis accounting, we lost money. No ifs, ands, or buts. So, for the year, we lost $160,000. But because we had previous equity, even after we back our accounts payable and prepaids, we have a positive 167 going into 2021. So two different issues, what happened in 2020 and what we're going into 2021 with.
That's what everybody's asking.
I'm sorry, what?
That's what everybody's asking.
That's what everybody's asking. Oh, sorry, I couldn't understand you.
So is that because of the previous board's actions that far in the red, or?
No, I mean, like I said, you 1.5 months, I'd rather you be at 3. So it's a process that grows from day one with the association. They have good things that happen, they have bad things that happen, they have unanticipated things. Sometimes we get a windfall, I got some associations get a windfall. So it's a matter of seeing what we got, managing it, as a board making decisions on what's best for the association. And lots of times, to be honest with you, the boards don't make the hard decision of raising fees when they have to. And that's when it puts further strain on the boards in the future. I got associations being special assessed $6 million. Not pretty. Yes.
Gail Metcalf, Unit 6. Could you tell us the difference between accrual and cash?
Yes. Accrual basis is what GAAP requires, and you match your revenues and expenses. So when we send out our billing on January 1st, that becomes income, or for the contract liability for the reserves. When we incur an expense, so let's say we cut down and trimmed a bunch of trees here, and the bill was $20,000, it happened in December, but we didn't pay it till January. We have to accrue that liability to match it when it took place. Whereas a cash basis, it's cash in, cash out. So if you paid for the bill in January, it's a January expense. If you collected them, if you sent somebody a bill in January for their fees, and they don't pay it until March, then that's March income. But accrual accounting, even though it's harder to understand, harder to maybe grasp around, that's what's required by GAAP, and all major companies required to use it. That's how we're required to do our financial statements.
Just as a follow-up, Brookridge is run not on a cash basis, but on an accrual basis. Does that make a difference?
Can you repeat that again, please?
Yes. Brookridge is run on an accrual basis, not on a cash basis. Does that make a difference?
Make a difference on what?
Whether we finish the year with a loss or a positive?
Oh, I mean, accrual basis is what we do. So we had some timing differences between bad debt and depreciation. I can go through the list of which ones are. But yeah, it's totally different numbers. You do cash, you do accrual, you'll get two different numbers totally. Everything we're talking about is accrual basis.
Okay, so I guess that's where I think some of the confusion is. On one respect, you're saying that we're 160,000 in the red based on the accrual basis, but we're $158,000 to the positive on a cash basis.
No, ma'am.
Okay, I'm sorry.
All I'm saying is we lost X number of dollars, but because we had, it's sort of like when because we had operating funds of 300-something thousand, now we just reduced what we had. So it's still an accrual basis number, it's just that we had excess from previous years, which I strongly recommend.
Vince Pease on unit 3. You said we had like 427 in the bank or, ending 2019, then ending 2020, we had 327, correct?
Go back to-
Somewhere in that area?
Yes.
So there's your 160,000.
It just.
It's just a matter of what you started your checkbook with
Yeah.
at the beginning of the year and what you ended with, there's your negative.
And it's kind of coincidence because it doesn't know.
Am I correct on that statement? Am I correct there?
Yes.
Thank you, Vince, that's what my next question.
Yes, ma'am.
So when you're, maybe to help explain, you're kind of like doing the taxes where you're writing off, and that way you don't want a positive ending being in the black. You're shooting for more in the red when you're filing your taxes, so you don't have to, the income taxes to pay.
Yes and no, not really for an HOA or a condominium, but for a closely held business, that guy wants to reduce his taxes, but then when he goes to get a loan, he's wondering why he can't get a loan, so, you know, the numbers kind of are what they are.
Donna McGuire, Unit 3. My question is, at any time, will we ever see the $160,000 come back all the way? Or is that just gone?
Oh, it fluctuates each and every year. It can go up, it can go down. It's just a matter of what income we have, what expenses we have. Yeah, it can go up and down, it just depends.
Sue Patterson, Unit 4. Can you tell us where that $158,000 went?
Yes.
I'm under the impression that we have a reserve. And anything big objects has been allocated year after year for the reserves, like the lawnmower and the new truck. So where did that $158,000 go? I think we have a right to know.
The equipment and stuff goes in the reserve funds, doesn't go in
Correct.
operations. You have an income statement that shows here's our income, here's our expense items. So you can get a copy from the association that shows here's all the expense items. So you know where it went. Salaries, I mean, the whole list of G&A stuff. A lot of it was bad debt, and a lot of it was depreciation also. So 60,000 was depreciation and 78,000 was bad debt. Those are the two of the major ones.
Okay, next question. I don't know about everybody in this room, but myself, we moved in here because we own our own land, and we have a say on what happens as far as the budget passing. Things are not supposed to be done by the board. All of us residents are supposed to have a say. Correct. But can they automatically, if the budget doesn't pass, say, well, we can put everything aside and we can raise the budget $50 if we want?
Yeah, I'm not an attorney. Can't check with the attorney. Just remember what I told. you asked about the $3, it's gonna be 15 by the time you get your reserve study back. So, you know, I'm just being honest with you. Thank you.
Anybody else have a question?
Thank you all very much.